5,002 tons. That's $555 billion. The World Gold Council just confirmed it this morning. Global gold demand hit a historic record. But here's what they're not telling you on CNBC. This isn't a gold rush. This is a stampede. And stampedes end at the cliff. Look at what's happening right now as I speak. Microsoft is down 6.5% in after-hours trading. Azure, their entire cloud computing infrastructure, just failed catastrophically. NVIDIA, the darling of the AI revolution, has collapsed 38% from its highs. Intel plunged 17% yesterday. The AI bubble isn't leaking. It's exploding. And where is all that panic capital going? Straight into gold ETFs. $89 billion in inflows in 1 week. That's not investing. That's terror. That's the herd running for the exits, grabbing the first shiny object they see and calling it safety. But let me ask you something. If your house is already on fire, does buying fire insurance make sense? Because that's exactly what buying gold at $5,538 per ounce looks like today. You're not an investor if you're buying gold right now. You're a victim. You're the person who buys the insurance after the house burned down, wondering why the premiums are so high. The AI dream is dead. Microsoft just proved it. NVIDIA confirmed it. The nightmare has begun. And $555 billion in gold demand is the market's admission that the emperor has no clothes. The tech sector that was supposed to change the world, it can't even keep its servers running. Here's the trap. Every financial talking head on television is telling you gold is safety. Gold is a hedge. Gold is protection. And technically, they're right. Gold is all of those things. But timing is everything. And buying protection at all-time highs, after the disaster has already started, means you're paying maximum price for minimum protection. The smart money didn't buy gold at $5,500. They bought it at $4,000, at $3,500. They bought when everyone else was chasing Bitcoin and AI stocks. Now, while you're buying their gold at the top, they're quietly rotating into something else, something the mainstream hasn't figured out yet. And that something is the reason you're watching this video. Because while $555 billion flooded into gold this week, creating the biggest demand spike in recorded history, there's a metal sitting right next to gold that's mathematically undervalued, physically scarce, and about to experience a price movement that will make gold's rally look like a warm-up. But before I show you the chart that reveals everything, I need to know where you stand. Because this isn't just about data. This is about psychology. This is about whether you're going to follow the herd off the cliff, or whether you're going to position yourself on the other side of this trade. Stop. I want you to do something right now. I want to see if this community is smarter than Wall Street thinks you are. This is a battle between fear and math, between the herd and the algorithm, between playing defense with everyone else, or playing offense with the banks who are about to make billions while retail investors hold the bag. If you were one of the few people smart enough to sell the AI top, if you saw NVIDIA at 38% down and said, "I'm out," if you got out of Microsoft before Azure collapsed, hit the like button right now. Let's confuse the algorithm. Let's show them that not everyone is buying the narrative. But here's what I really want to know. Here's the vote that matters. Go to the comments right now. I want to see where this community actually stands. Are you playing defense with the herd? Or are you playing offense with the banks? Type Team Gold if you want safety. If you believe the narrative. If you think buying gold at $5,538 is the smart move. Type Team Silver if you want wealth. If you understand that the real trade isn't the asset everyone's talking about, it's the asset nobody's paying attention to. Cast your vote now, because in the next 60 seconds, I'm going to show you exactly why one of these teams is about to get very, very rich, and the other team is about to learn an expensive lesson about buying at the top. I'll wait. Go to the comments. Team Gold or Team Silver? Vote now. All right, by the time you finish this video, you're going to understand exactly why your vote matters. Because the data I'm about to show you doesn't care about sentiment. It doesn't care about CNBC headlines. It doesn't care about the $555 billion that just flooded into gold. The data cares about one thing, mathematical certainty. And the mathematical certainty is this. When fear drives prices to extremes, the snapback is violent, predictable, and profitable if you're positioned on the right side of it. Let me show you the chart they don't want you to see. The gold to silver ratio. Right now, as of this morning's trading session, It's sitting at 47.21 to 1. What does that mean? It means you need 47.21 ounces of silver to buy 1 ounce of gold. Now let me give you some historical context. In 2011, at the peak of the last precious metals supercycle, that ratio hit 32 to 1. In 1980, it hit 14 to 1. Right now, we're at 47 to 1. Silver is trading at a 40% discount to its historical equilibrium with gold. But here's where it gets interesting. This ratio doesn't stay stretched forever. It's like a rubber band. The further you pull it, the harder it snaps back. And right now, this rubber band is stretched to levels we haven't seen since gold was half the price it is today. Let me show you what's already happening. This is the 7A data, straight from the markets. Gold is up 15.8% over the last 7 days. Silver is up 28.8% over the last 7 days. Read that again. Gold moved 15.8%. Impressive. Historic, even. But silver moved 28.8%. Silver is already outperforming gold by nearly 2 to 1. And we're just at the beginning of this move. This is the snapback starting. This is the rubber band releasing tension. Gold is walking up the stairs. Silver is taking the elevator. And here's why this matters. When fear drives capital into gold, it's a slow, methodical move. Institutions buy, central banks buy, ETFs accumulate. It's steady. It's measured. It's the stairs. But when that fear releases, when the herd realizes they overpaid, when the ratio starts reverting to the mean, silver doesn't walk back down. It crashes back to equilibrium. And that crash is violent and fast. Let me give you the math. If the gold to silver ratio reverts to its 2011 level of 32 to 1, and gold stays at $5,500 per ounce, silver goes to $172 per ounce. That's a 56% gain from today's price. But here's the thing. Gold isn't going to stay at $5,500. Not with an RSI of 95. Not with every technical indicator screaming overbought. Not with the banks positioned the way they are, which I'll show you in a moment. When gold corrects, and it will correct, silver doesn't follow it down proportionally. The ratio compresses even faster. If gold drops to $5,000 and the ratio compresses to 35 to 1, silver goes to $143. If gold holds at $5,200 and the ratio hits 32 to 1, silver goes to $162. Do you see what's happening? Silver wins in both scenarios. If gold goes up, silver goes up faster. If gold goes down, the ratio compression keeps silver elevated. This is why Bank of America's analysts are saying silver could hit $135 per ounce if we return to the 2011 ratio. This is why their bear case, their worst case scenario, still has silver at $100. But let me show you the real kicker. The 7-day move we just saw, gold up 15.8%, silver up 28.8%. That's not the anomaly. That's the pattern reasserting itself. Go back and look at every precious metals rally in history. Gold leads. Silver follows. But silver always outperforms on the upside. In 2011, gold went up 70% from its lows. Silver went up 440%. In 1979 to 1980, gold tripled. Silver went up 10x. The lag is the opportunity. And right now, we're in the lag phase. Gold hit all-time highs 3 days ago. Silver is still 15% below its all-time high from 2011. Gold is priced for perfection. Silver is priced for pessimism. And here's something most people don't realize. The gold to silver ratio isn't just a number on a chart. It's a measure of market psychology. When the ratio is above 45, it means fear is driving decisions. When it's below 35, it means greed is driving decisions. We're at 47 right now. Fear is at maximum. But here's the historical pattern that nobody's talking about. Every single time, and I mean every single time, the ratio has stretched above 45 to 1 in the last 50 years, it has snapped back violently. Not gradually, violently. In March 2020, the ratio hit 123 to 1 during the COVID crash. Everyone thought precious metals were dead. Within 5 months, the ratio collapsed to 72 to 1. Silver went up 142% while gold went up 35%. In 2016, the ratio hit 83 to 1. The market said silver was worthless. Over the next 12 months, the ratio compressed to 68 to 1. Silver outperformed gold by 3 to 1. In 1991, the ratio peaked at 100 to 1. Within 2 years, it was at 60 to 1. Silver doubled while gold went sideways. Do you see the pattern? The ratio doesn't stay stretched. It can't, because silver isn't just a monetary metal like gold. It's an industrial metal. And industrial demand doesn't care about the ratio. Industrial demand creates a floor, and that floor forces the ratio back to equilibrium. Right now, at 47 to 1, we're not at the extreme levels of 2020 or 2016, but we're stretched beyond the normal trading range of 30 to 40 to 1. And with gold at all-time highs, with fear at maximum levels, the conditions for compression are perfect. And while retail investors are panic buying gold ETFs at record levels, the smart money is doing something very different. They're buying silver, quietly, methodically, and in quantities that are starting to break the physical market. Let me show you what I mean. Now, you might be thinking, okay, the math makes sense, the ratio makes sense, but what if I'm wrong? What if silver crashes? Here's why you're not wrong. Because unlike gold, which is driven purely by sentiment, silver has a floor. And that floor is built by industrial demand that doesn't care about your feelings. Let me give you 3 data points. First, Samsung. On January 20th, 2026, 9 days ago, Samsung announced a $7 million contract for physical silver delivery. Now, $7 million doesn't sound like much, but here's what matters. Samsung isn't speculating. They're not trading. They're manufacturing. They need silver for their semiconductors, their solar panels, their electronics. And here's the critical point. If silver drops 10%, retail investors sell. But if silver drops 10%, Samsung buys everything available. Because for them, it's not an investment. It's a production input. And production doesn't stop because the price dropped. That $7 million contract, that's the floor. That's industrial demand creating a bid under the market that didn't exist in gold. Second, China. On January 1st, 2026, China implemented a total export ban on refined 999 silver. Not a tariff, not a quota, a complete ban. Every ounce of silver China produces stays in China. Why does this matter? Because China is one of the world's largest silver producers. And now, all of that supply has been removed from the global market. Western manufacturers, Indian importers, European traders, they're all bidding on a shrinking supply pool. The futures market is already showing the strain. Shanghai silver is trading at a $5 to $8 premium over London and New York spot prices. That's backwardation. That's immediate demand exceeding future supply. That's the physical market screaming, there isn't enough. Third, COMEX. The registered silver inventory at COMEX, the exchange where silver futures trade, just drained 33 million ounces in 7 days. That's 26% of registered inventory gone in 1 week. Let me put that in perspective. Registered inventory is the physical silver that's available for delivery against futures contracts. It's the actual metal backing the paper trading. And 26% of it just vanished. Where did it go? Physical buyers. Sprott Physical Silver Trust just doubled their at-the-market program from $1 billion to $2 billion. They're buying physical silver, not paper, not futures, actual bars and actual vaults. But here's the really interesting part. The Sprott announcement came on January 20th, the same day Samsung announced their contract. These aren't coordinated moves. These are independent actors all reaching the same conclusion at the same time. Physical silver is scarce. And when independent actors reach the same conclusion simultaneously, that's not a trend. That's a structural shift. Look at the COMEX data more carefully. Total open interest in silver futures is at record levels. But registered inventory, the actual deliverable metal, is at multi-year lows. That's a squeeze setup. That's more paper claims on physical metal than the exchange can actually deliver. JP Morgan alone issued 99% of the 8.1 million ounces through 1,624 delivery contracts in January. One bank, 99% of deliveries. They're not speculating. They're controlling supply. And here's what happens next. As registered inventory continues to drain, as physical buyers continue to stand for delivery, the futures market has 2 choices. Find more physical metal, or let the price rise until demand destruction occurs. But here's the problem. Industrial demand doesn't experience demand destruction at $110 silver or even $150 silver. Samsung doesn't stop making semiconductors because silver went up 30%. They pass the cost to consumers or they eat the margin. But they don't stop producing. So the futures market has only one choice: find more metal. And there isn't enough. India acquired 900 million ounces of silver over the last 5 years. That's more than the reported LBMA holdings over the same period. They're not buying gold. They're buying silver, both as a reserve asset and as a strategic industrial input for their solar energy build-out and defense manufacturing. And it's not just India. Look at the Shanghai premium. Physical silver in Shanghai is trading $5 to $8 above London and New York spot prices. That's backwardation on a geographical basis. Chinese buyers are paying a premium for immediate delivery because they can't get the metal through normal channels. Why? Because China banned exports on January 1st. Every ounce stays domestic. Do you see the pattern? While the herd is chasing gold at all-time highs, sovereign nations are hoarding silver in tonnage. While retail buys paper gold ETFs, institutions are draining physical silver from exchanges. While CNBC talks about gold's safe haven status, Samsung is writing contracts for actual silver delivery. This is the floor, and the floor is rising. Here's why this matters for your trade. If you buy gold at $5,538 and it drops to $5,000, you're down 10%. There's no floor. There's no industrial buyer stepping in. You're just underwater, hoping sentiment reverses. But if you buy silver at $110 and it drops to $100, Samsung buys. China hoards. COMEX inventory drains further. The industrial floor catches you. And then the ratio compression kicks in, and you're back to $110 within weeks. Gold has sentiment. Silver has a safety net. And that safety net is built by entities that aren't trading, they're consuming. Now let me show you the final piece of this puzzle. The piece that turns this from a good trade into a generational opportunity. 5,002 tons. $555 billion in gold demand. The World Gold Council called it historic. And they're right. It is historic, but not for the reason they think. This wasn't a buy signal for gold. This was the starting gun for silver. Here's what just happened. The AI bubble popped. Microsoft, Nvidia, Intel, the entire narrative collapsed. And $89 billion in panic capital rushed into gold ETFs in 1 week. That $89 billion created the demand spike. That demand spike pushed gold to $5,538. And that price pushed the gold to silver ratio to 47-1, stretched beyond any rational equilibrium. Now the rubber band snaps back. Gold is already showing the technical signs of exhaustion. RSI at 95, the highest reading in decades. The last time gold hit an RSI of 90 was October 2025. What happened next? A sharp $200 correction within 2 weeks. But here's the difference. When gold corrected in October, silver didn't follow it down. The ratio compressed. Silver held its ground because industrial demand created the floor. And now, with China banning exports, with COMEX inventory draining, with Samsung and India buying physical tonnage, that floor is higher and stronger than it's ever been. The 7-day data already confirms it. Gold up 15.8%, silver up 28.8%. The snapback has already started. This isn't prediction. This is observation. But here's what most people don't understand. The real money in this trade isn't made when silver goes from $110 to $120. That's nice. That's a 9% gain. The real money is made when the ratio compresses from 47-1 down to 35-1, down to 32-1. Because when that happens, silver doesn't just outperform gold. Silver goes parabolic. Look at the historical pattern. In 2011, when the ratio hit 32-1, silver was at $48 per ounce. If we hit that ratio today with gold at $5,500, silver goes to $172. That's a 56% gain. But let's say gold corrects to $5,000, which every overbought indicator says it will. If the ratio still compresses to 35-1, silver goes to $143. You still win. This is the asymmetric trade. Gold's upside is capped by technical exhaustion and commercial short positions, which I'll explain in a future video. But silver's upside is driven by ratio compression, industrial demand, and a physical supply crisis that's just beginning. The $555 billion gold demand wasn't the signal to buy gold. It was the signal that fear has reached maximum levels, that the herd has stampeded into the obvious trade, that the smart money is now positioned on the other side, and the other side is silver. Let me be clear about something. I'm not telling you to sell your gold. If you own physical gold, keep it. Gold is insurance. Gold is a hedge. Gold will hold value when everything else collapses. But if you're allocating new capital today, if you're looking at the market and asking, where's the opportunity? The answer isn't the asset trading at all-time highs with an RSI of 95. The answer is the asset that's mathematically undervalued, industrially essential, and physically scarce. The answer is the asset that moved 28.8% while gold moved 15.8%. The answer is the asset that has a floor built by Samsung, China, and India, not a ceiling built by fear. Here's my final point, and this is critical. Every major precious metals rally in history follows the same pattern. Gold leads. The herd follows gold. The headlines scream about gold. And while everyone's watching gold, silver quietly sets up the generational move. Let me walk you through the exact mechanics of what happens next. Phase 1 is already complete. Gold hits all-time highs on fear-driven demand. That's done. We saw it 3 days ago at $5,594 per ounce. The World Gold Council confirmed it with their 5,002-ton demand figure. Phase 2 is happening right now. Silver begins outperforming gold on a percentage basis. We're seeing it in the 7-day data. Gold up 15.8%. Silver up 28.8%. This isn't an anomaly. This is the pattern asserting itself. Phase 3 is what happens next. The gold-to-silver ratio begins compressing as smart money rotates from the overbought asset, gold, into the undervalued asset, silver. This typically takes 4 to 8 weeks. We're 1 week in. Phase 4 is when retail finally notices. Mainstream media starts covering the silver rally. CNBC runs segments on why silver is outperforming gold. Bloomberg publishes articles about COMEX inventory drains. And retail investors who bought gold at $5,500 start asking, should I switch to silver? But by then, silver is at $140. The ratio is at 38 to 1, and the easy money has already been made. This is the pattern. This is how it always works. In 1979, gold tripled from $200 to $600. Everyone bought gold. The headlines screamed gold rush. And while everyone was buying gold, silver was setting up the real move. Over the next 12 months, silver went from $6 to $48. That's an 800% gain. Gold went from $600 to $850, a 42% gain. The people who bought gold at $600 made money. The people who bought silver at $6 became wealthy. In 2011, gold went from $1,100 to $1,900, a 73% gain. Everyone talked about gold. Gold was on magazine covers. Gold was the safe haven. And while that was happening, silver went from $18 to $48. That's a 167% gain in the same time frame. Same pattern, different decade. We're watching it happen again, right now, in real time. The World Gold Council just confirmed it. $555 billion in demand. Historic record. The herd is here. The magazine covers are coming. The top is forming. And while they're buying gold at $5,538, with an RSI of 95, with technical indicators screaming overbought, with commercial traders positioned net short, you have the opportunity to buy silver at $110, with a gold-to-silver ratio stretched to 47 to 1, with industrial demand creating an unbreakable floor, with COMEX inventory draining at 33 million ounces per week, with China banning exports and keeping all domestic production, with Samsung writing contracts for physical delivery, with India accumulating 900 million ounces in 5 years, with Sprott doubling their purchase program to $2 billion, and with the 7-day chart already confirming that silver is moving 1.8x faster than gold. This isn't speculation. This isn't prediction. This is observation of a pattern that has repeated itself for 50 years. The only question is, are you going to recognize it this time? Or are you going to be the person who bought gold at the top? watched silver rally 150%, and said, "I should have seen that coming." Because the data is right here. The setup is clear. The opportunity is now. If you voted Team Silver in the comments, you already know the answer. Stay the course. The ratio compression is just beginning. The physical squeeze is just starting. The snapback is underway. Subscribe to this channel if you want to see the next phase of this trade. Because when the gold to silver ratio hits 35 to 1, I'll show you exactly what happens next. When it hits 32 to 1, I'll show you why silver at $170 is just the beginning. And when the mainstream media finally catches up, when they start running the same headlines they ran in 2011, in 1980, every single cycle, you'll already be positioned. Because you didn't follow the herd into gold at all-time highs. Because you didn't buy the insurance after the house burned down. You bought the asset that has a floor, a catalyst, and a mathematical destiny. You bought the asset that sovereign nations are hoarding while the media isn't watching. You bought the asset that moved 28.8% while gold moved 15.8%. You bought the asset that the banks are quietly accumulating while they publicly upgrade gold price targets to create exit liquidity. The 5,002-ton signal wasn't a buy signal for gold. It was the confirmation that fear has reached maximum levels. It was the proof that the herd has arrived. It was the starting gun for silver. Now you know. Now you act. Or you watch from the sidelines and wonder why you didn't see it when all the data was right in front of you. Your move.